Good morning, everybody. It's Friday, December 29th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop those in the chat section, and we'll get to those during the show. We also can always be reached at info@agyield.com. Quickly here, overnight markets had March corn down a penny at 473 1/4. January soybeans were down 2 1/4 at 1303, and March Chicago wheat was down 1/4 at 631 1/4. We had weekly export sales released here this morning. Corn was pretty solid at the upper end of the estimates with little over 1.2 million for 23. There was 11,000 sold for 24. Soybeans, I'd say disappointing at the lower end of the estimates, under a million at 983,000. And wheat also at the lower end at 276,000 for 23, 41,000 for 24. Meal sales came in at 268,000. Also overnight, we had 382 bean deliveries from JP Morgan. And so I think we'll kick it off there this morning, just talking about the soybean complex. I think there's quite a, on a slow news day going into the end of the year, I'd say the soybean complex probably has the most going on. We got a shift in forecast in Brazil, shifting wetter from everything we're looking at. So Dustin, what's your thoughts here? Last trading day of the year, we're going to put a bow on it.
Yeah, definitely. Well, just put it in more of a macro context, funds have been reducing length. We'll get their updated numbers of what they've done through Tuesday. Please mind my cold too. Sorry, Dan.
We're all sick, man.
And, we'll get the COT report data later this afternoon to see where they stand. But, they largely were down to a fairly neutral position in beans. And they've also, just based on what they're doing on their products too, it's been a pretty big shift overall away from the length. And that's what's taken us from, the near $14 price down to the near $13 price. So we have to think about that, what is it capable of doing? Either way, we're going to be probably pretty tight in this country. We have crush demand kind of falling a bit, likely with this lower margin. We hit 2 record numbers in a month, however. But all these rumors that we've had that China has been buying beans last week or so, they have not shown up on the report. Then today we get a bunch of deliveries. So in the spread from Jan to March, it narrowed up quite a bit. It's not, short term it's a kind of a negative outlook right now for beans. And so if it goes out and takes out that 1280 low, it could get interesting just because that's where, that's where we've kind of held support so far. And that would be a new low going back to understanding the new acreage that we had following the June 30th acreage report. I think that's the one thing to keep in mind is we really had a very few amount of acres for beans. We still don't have the final count yet for what we actually grew. We're going to find that out in the January WASDE and quarterly stocks numbers when we actually count the stocks. And a lot more will be known here in the next 2 weeks once we get through that data. And, when you're coming from a 6% stocks to use ratio, we're kind of on the precipice of not having, an excessive export number. And we're seeing that Brazil is getting some of these rains. We're kind of more comfortable with that. The difference of getting a higher than expected yield or a lower than expected yield on that report can be a big net change on a percentage of carryout basis. So I think that just raises the stakes for this January 12th report as we go into it, is that it's all going to kind of depend on where the USDA stocks count came in at.
Sure. Ben, I know you were looking at some pretty interesting open interest in charts and things of that nature as you look year over year. Do you do a lot of reflection here at the end of the year and where we've come from and where we're at? I thought you had a couple of neat tidbits there this morning.
Yeah, we last year on the last trading day of the year, March corn traded a high of 685. It closed lower that day. When you look at it, end of quarter, end of the month, end of the year can be a really interesting time for managed money. bonuses, positions, things of that nature. So I would expect a choppy trade from that standpoint. After we put that high in, we broke 35 cents pretty quick last year. Managed money was long, about 200,000 contracts at that time. And, as we go into this morning, they're short, probably approaching that, 185 to 200, somewhere in there. So, you see these end of quarter type of moves, end of year. I think it's a really good time to not stick your flag in the sand at up 1 or 2 cents or down 1 or 2 cents in any commodity at the end of the year, from a trader's perspective. So I think it creates an opportunity if you're looking to do something, to keep an open mind going into a day like today. And we'll be looking forward to, what the new year brings. I think that corn is a fundamentally bearish market, and the spreads reflect that. The poor price reflects that. We're over $2 lower today than we ended the year last year. But it doesn't mean that in these heavily short markets that we can't have fits of short covering, spikes and rallies. We have to engage the offer, or the offer has to come down to the bid. And I think that the thin nature of these markets, traders they're ending their year, and hopefully it's on a really good high note. And the proclivity for risk when you zero those accounts out at the end of the year gets diminished going into a new year, because no one wants to work from a debit or a hole. So I think it creates an extra added element of volatility headed into the new year. Historically in bear markets, once we get through the January report, we might go into really kind of a doldrums. But I think the first up into that report creates a lot of chances for people to reposition and do some different things. So just keeping my eye on that, and a good day to sit back and see what happens. So we are sniffing up against the lows for the move here as well in corn. If you're a managed money and you really want to put the kibosh on this thing on a day like today, a lot of traders refer to it as the pump and dump or the dump and pump. And I think we'll have a choppy trade today. So maybe in both directions.
Overnight's kind of told us that too, guys, I was talking to a group yesterday, and, I thought it was kind of an interesting question, but it was just like, we've started to see a gradual shift in weather conditions in South America, right? By all estimations, the next couple of weeks, they're scheduled to get some pretty favorable rains through really key areas. I know it's hard to quantify, but do we feel like there's a bunch of risk premium still in this market, or have we gradually been paring back some of that South American weather? I mean, what's your opinion, Dustin?
Yeah. Say that again, Dan. I'm sorry. I misunderstood the question.
Yeah, I think it was, it's more of just discussing the fact that, like, if, we're seeing a shift, potentially into a much wetter pattern for South America through really key growing areas, right? And the question was posed, like, how much premium, do we think is really built into this thing at this stage? Is there premium built into this stage, or what's the market's foreshadowing, right? That's what it does.
Yeah, no, I think that's a good question for sure. Because I had a question yesterday from customers, like, where do you think, these 24 corn could go, and where no 24 beans could go at the end of the year? Right. And ultimately, if all things hold stable and weather becomes known as normal and we hit trendline yield, I think prices would be lower, right? Under a very steady vacuum of other information, not knowing anything else. Sure. Generally, that's what we expect out of the market. There's seasonal patterns that once we get all the excitement and the unknown about weather known, and we end up coming out with an okay yield, things start to come out. Brazil's a very big country, very big growing region. It's not like they had, a stellar start to the season. We were still quite dry coming into this period. We're just getting rains at a very critical stage of their growing season. And it's different for different growing regions as well. I think the big thing is that we had so many acres down there that we were already, expecting, a couple months ago, record production at trendline yields because of just expanded acreage. And you have some problems, but it's not a disaster. You're still well above what we've been growing 3-4 years ago in that region because of the expansion of acres. And how does the market perceive that? Is there weather premium to still come out? I think there could be, for sure. I still think there's a question about like what was the net reduction from trendline? Was it a couple percentage points? Was it 5 percentage points? There's obviously a huge debate going on Twitter about this.
Yeah.
So it will be a little while for us to really determine that. It's kind of more measured on the exports, really. The market's pretty good at figuring that out through that time frame. I just go back to the idea that, well, a couple months ago, we knew that we had record hectares in coming out of Brazil prior to knowing any of the dryness problems that we were about to lead into, and we were still able to trade $14 beans, right? And then since then we've had lower yields. So what is fair value for beans? The fact that we've already broken $1, it's hard for me to determine, when we are going to be extremely tight in this country, that like the price needs to continue to fall. I mean, I am definitely in a situation where I want to just go back to margins-based marketing and say, I don't want to take a really strong stance on beans right now because I see localized tightness. I see, global abundance building again, potentially. But that can lead to some very interesting price moves. You still can get rallies that you don't expect. So if we were to see $1 rally in beans, I guess I wouldn't be that surprised, just because, we're tight enough for that to happen here and there. Would I be, as a producer, taking advantage of that? Absolutely. I mean, that'd be a very exciting thing to see. So I don't want to be too strong on it. I guess, we're never want to be too strong on opinion, but I think especially right now, we got localized tightness, global abundance. That's a question. I just want to be even keel hedged for a producer on my risk going into 24.
That's good stuff. Rest that voice, buddy.
I just added that to it. I think that this is a place with beans where you got to have a lot of humility and looking at price potential. We've mentioned this numerous times on here, and we've gone into, 4 or 5 weeks in a row with rains, and maybe not ideal rains, maybe not the coverage or the amounts that people would like, but we've just kind of stayed in this choppy range, which I think is enough uncertainty that no one really wants to hammer it down, so to speak. And I don't think anyone's confident enough to buy it up. And, fundamentally, from the gauges that you look at on trends, it's now in a bear market, and a confirmation of that would be, to Dustin's point, close down around below 80. And I just think that traders don't have a lot of confidence either way, and it's kind of manifesting itself in price of what we've spoken about before, that it's in a trading range. We're at the lower end of that range. And there's enough uncertainty for now that I don't know that anyone wants to get really short them, or anyone wants to really be long them aggressively. So it winds up being a chop. I could see us potentially moving the chop in the range lower to 1270 to 1330 for a while, kind of high end of what we saw yesterday. We go back to a year like 16, and we start getting the range. We still have a long way to go with beans down there. So just, again, margin-based marketing and a level of comfort.
Yeah, Ben, I want to add to that. So we were talking about that here, I think it was yesterday. And, there's some nuances on how you hedge things. Some people will pick pockets of the market to hedge, right? And that would be like a put spread, for example. And other people will make sales, which gives you protection all the way down to zero. If you're a producer, you're considering the million different things you can do for hedging, whether to hedge or not hedge, or how aggressive to be. And I would say this, when you look at a long-term chart of beans, your perspective changes when you pull up a monthly chart versus a daily chart, because we are still at a much higher price than what we would have been accustomed to at many times in the last 10 years. So if we're running into a hot geopolitical time frame, you've got Taiwanese elections, January 13th, you've got, big changes that could come from just a slightly higher yield than expected January 12th, right? Some very big things coming in the next 2 weeks, especially, but certainly over the next 12 months, we're capable through financial incentive of resupplying the world between North America, South America, and beans, especially when we had so many corn acres this year. So, what could NOV 24 beans get down to? Yeah, when you look at the long-term monthly chart, it could get pretty low if we get the right conditions to do that. So I wouldn't be hedging over the longer term, just small pockets. I wouldn't be doing accumulators that don't have a guarantee on them, right? Because you get knocked out and you have no coverage, and you're just left with whatever you can fall back to on insurance in that case. Those are the things I wouldn't be doing. I'd be trying to create some sort of certainty that actually has a floor, ultimate floor, if you're talking about long-term hedging on beans. And I don't want to get too much into the weeds there. I mean, this is something we discuss with our client base, but I think that we're, long-term security is what I would be preferring in this type of hot geopolitical environment.
Perfect. Yeah, well, I mean, you look at last year, we took beans all the way to 11.30 from this time of the year to May, and it was pretty aggressive. And our bounce highly attributed to dry weather in the U.S. So I think all great concerns, especially when you factor in the evolving U.S. green initiatives with soybean, right? We're kind of transitioning to a larger domestic user, while we're probably losing exports over a period, as we transition over the next year or two. So it certainly is food for thought. I like what you say about keeping a floor on whatever it is that you're trying to do in soybeans.
Very good. Right, we're coming into the open here real quick. Anything that we need to look at on the last day of the year for cattle and livestock there?
Not too much, Dan. I mean, the market's been totally sideways. It seems like we're just kind of caught in the end of the year between, too high to buy and too low to sell. So I think we're just waiting for more information. Cash trade was actually good. Beef prices took a little bit of a nosedive yesterday. So it just kind of feels like we're two-sided. We got Dees going off the board, so Feb's going to be front month. And we just want to make sure that, or at least kind of pay attention to that spread. It looks like going into the roll, managed money still long. Could see the pressure on that spread over the next week, but seasonally Febs typically start to gain. So I would say that that's probably a little bit more of a seasonal kind of demand thing, which could manifest probably if we get some good news on the cattle inventory report. So we closed in hogs yesterday as well. Just seems like we're kind of limping in the new year. Just we've got an overabundance right now, and demand is definitely a little bit on the soft side. Weekly exports weren't great in either place. So just feels like we're kind of limping into the end of the year, and just kind of waiting to see what kind of demand we see after we kind of get through that New Year's flush. So not too much new here, Dan, just kind of sideways for cattle and still a little weak for hogs.
Very good. Appreciate that. Opened here this morning, March corn down 3/4, 473.5. January soybeans off 4 1/4 at 13.01, and March Chicago wheat's down 4 3/4, 626.5. Before we wrap here, real quick, thanks to everybody for tuning in as we've launched War Room here, towards the end of this year. We're really excited going forward. We've got a lot of new things we're going to be bringing to the table, and we appreciate everybody's, subscribing and all the real positive feedback we've got. We're having a lot of fun with it, and we want to continue to grow it. So we appreciate that. Also to our clients, thank you very much. It was a fantastic year. We look forward to servicing all of you here in the new year. And to everybody that's tuning in this morning, Happy New Year, stay safe. And we look forward to picking back up on Tuesday. We're going to have our hard open at 8:30 Central Time. And we will be on the War Room at 8:50 into the open. So every day that we're open, we stream live on X. Facebook Live and YouTube Live. And once again, Happy New Year to everybody. And we'll talk to you next week. Have a good weekend.
Thanks, Dan.
Happy New Year.